Oil companies are in freefall while SUV sales continue to surge on this energy edition of Industry Focus. Greetings, fools. I am Sean O'Reilly, joining you here from Fool headquarters in Alexandria, Virginia. It is Thursday, January 14th, 2016, and joining me to talk all things energy and industrials is Tyler Crowe and Taylor Muckerman. What's going on, guys?
Hello, hello, hello.
Not much.
Looking sharp in your vest there.
It's warm.
I know.
It's toasty.
Yeah.
That's all I needed today.
What is it outside? It was
It's
28
a
when
little
I left. Yeah.
A little chilly.
A little chilly. Not chilly for SUV sales, though. As a follow-up to last week's story where I think, Tyler, you were talking about how SUV sales and truck sales and everything are surging here in the U.S. because gas is, what, $1.90 or something?
$1.77 when I came in
boy.
Alexandria, Virginia today.
You fill up whenever you come to Virginia,
it's like the one turn, I make to the office. I have to go right by a gas station. And right there, it's like plastered right in front of my face. And I walk in, I drove in this morning, said $1.77.
Boom. I remember.
Did you get a big gulp?
No.
No.
It's not a 7-Eleven.
It's not a 7-Eleven.
What's a big gulp go for these days? One will gas be cheaper than a big gulp. That's what I
It
want
might
to know.
actually be because a big gulp is smaller than a gallon of gas.
Don't they pitch the big gulps like being $1.09?
But you can't refill your gas tank
Oh,
for free
well.
if you're still in the store.
Sorry. That's a good point, though.
Yeah.
Thank you.
Yeah, I'm sorry.
You must have taken some econ classes at one point. Anyway, so as a follow-up to last week, basically GM just announced strong guidance for 2016. They're doing a $4 billion buyback. They're saying they're going to sell even more cars this year. I guess cheap oil prices are having an effect, huh?
I guess you could say that. I mean,
A little bit.
Basically, they're guiding for $5.25, $5.75. Pretty large uptick from this last year. But one of the big things that I think a lot of people got excited from is that they're boosting their stock repurchase plan up to $9 billion, up from $5 billion, which obviously is saying we're doing pretty well and we don't have to reinvest a whole lot in the business right now. So let's give it back to shareholders. And I think that's been something that shareholders of GM and Ford have been kind of waiting for is, when is it our turn? It's been quite a while ever since, the downturn and all the issues that GM has had over the years. I'm sure there's a lot of shareholders have been kind of itching to be like, when is it our turn to really make those returns?
Well, they've returned a nice amount in the market since the government intervention, I think, right?
Yeah. I mean, maybe just people aren't noticing.
Yeah,
I guess
that's
would be
fair.
the best part about it.
So Taylor, as Tyler mentioned, Ford announced decent guidance and results and everything, but they just announced crazy sales from China. Now, last I checked, the Chinese stock market's crashing. They're always tripping their circuit breaker. There's talk about a pullback and slowdown there, hard landing, soft landing. But we're not seeing that in auto sales there. I think, they sold 18% more cars in China than last year. Like, where's the dichotomy here?
Well, I think what you're looking at is the Chinese are used to purchasing consumer goods. I don't know if they're necessarily used to purchasing stock. It's a very retail-heavy stock market, and it's fairly new compared to the U.S. market. So I think that they're still kind of learning how to adjust to the crazy growth that their markets had and the skittishness that investors over there might have. I saw a survey that indicated that they feel much more like gamblers over there in terms of investing.
The size of their stock market compared to ours relative to the sizes of each economy is infinitesimally smaller. It's way smaller.
Yeah.
Not only that, but their government buys stock on the open market regularly.
Yeah, there's a lot more finagling going on over there. So I wouldn't necessarily translate stock market performance to consumer buying habits
so
in China.
This seems to imply that the Chinese consumer is doing a little bit better than the headlines would lead you to believe.
Yeah, and you see that in like retail sales over there as well. So this has been historically not a super strong market for American car makers. So if they can make headway like this, then that's a totally new opportunity that investors can get excited about.
Yeah, was it the Ford CEO that I said? You may have missed it, and I can't recall, so it's fine. But I think the Ford CEO said we expect China to be huge for us someday. So
yeah, you would imagine so. I mean, there's a very small portion of the population that does drive. You just have to wonder if they more or less skip traditional automotives and just wait for EVs to come out. But you haven't really seen too much growth there either in terms of overall market share capture from EVs. So I think it's got a few years to run here for traditional vehicles and growth in China. And they're not seeing the only two companies that are producing high expectations. Magna International, which is a OEM parts supplier, they also build cars for smaller car companies, Canadian company, but they do trade in the U.S. as well. They even boosted their 2018 guidance. So that's
What?
a few years down the line. Just that they see some positive things happening.
Do they have a backlog? Like, how can they do that?
They
with any
do,
confidence?
yeah. And so they basically provide pretty much any part you can think of that has to do with
Spark
automotive.
plugs.
And you see their name mentioned in the discussions when you talk about an Apple car or a Google car.
Really?
They could potentially be the builder.
So they're in.
There's just been rumors like that an Apple executive visited a plant of theirs in Europe last
Interesting,
summer.
okay.
So it's just a way for this company to maybe see some optionality and getting into the autonomous driving market without just being a parts supplier.
Cool.
And kind of tying it a little bit back to energy here, one of the, there's tons and tons of factors that go into, the price of oil and a lot of the sentiment going around it. And one of the things that has been talked about a lot, at least as of late, was that we should start to see a waning Chinese demand for oil. And when you see sales figures that we've seen for automotives as of late, it makes you wonder what the metrics they're looking for for oil demand in China. Because if we look at manufacturer purchasing indexes, they're very far down, and a lot of times we've kind of gauged the Chinese economy on that manufacturing export sort of model. But if we're seeing such strong consumer demand, which is going to be one of the major drivers for oil, probably more so since it is primarily a transportation fuel, it does make you wonder, are the concerns that Chinese oil demand is waning
fair?
as much as some people are expecting it to?
Well, whenever I see any of this stuff, I'm not surprised by the stuff that's going on in China right now, the stock market crashing and everything, because their current goal is to shift from a export-driven manufacturing economy to a consumer-driven economy, a little bit more like ours. That's exactly what's happening. Their stock market's comprised mostly of export-driven manufacturers. It's, it is what it is.
Yeah.
Agreed. So before we move on, I do want to put things in perspective. Ford Tyler, and you broke this out before we went in. The North American car market is still a lot bigger than Asia. Was this $200 million or something like that? Yeah. For the third quarter.
200 million what?
Yeah. Pre-tax results by segment, and it's it is what it is.
It's, just to give a comparison, third quarter pre-tax results by Ford's segments regionally. North America was $2.6 billion. Asia Pacific, $20 million.
For profit margins.
So just let's keep it a little bit in perspective here.
Cool. Okay. Before we move on, I wanted to point our listeners to the newly redesigned focus.fool.com. There you'll discover a special discount on Motley Fool's Stock Advisor newsletter that works out to $129 for all IF listeners for a full 2-year subscription to start your year off foolishly. Just go to focus.fool.com to take advantage of this offer. Once again, that is focus.fool.com. And next up, we're talking about the free fall in Energy Transfer and Williams companies. We are, 14 days into the new year, and Williams partners and Williams companies are getting hammered. Down 40%, and it's even dragging down other parts of Energy Transfer, the Energy Transfer empire as well. Tyler, cause for concern?
Well, I mean, when you
Bartender needs to cut them off.
You've had enough.
So a lot of this has to go around the combination, merger, acquisition, whatever the heck you want to call it, of Williams companies and Energy Transfer. Last year, we had that kind of drama around it where Williams said, hey, somebody made us an offer to buy, but we turned them down because we think the stock was worth more. And then, then Energy Transfer came, said to everybody, we're the ones that are buying. We think we can make this happen. We're going to tell everybody
I remember
it's
this.
worth it.
It sounded very high school at the time. And
Oh,
it sounds
it did.
very high school now.
We were talking about hostile takeovers and everything. And now we've had a couple balls start to roll in the MLP space where Kinder Morgan cut its dividend, and a lot of people were getting concerned. Oh, what if they lose their credit rating? And so they had to make that big move to cut their dividend to keep their credit rating intact. Williams Company just recently had its credit rating downgraded by Moody's from one notch above, the line
Junk,
for
so it's like C,
one line above investment down to just that one notch between below into junk territory.
Okay.
Which is, for a large MLP, not very good.
No.
Not very good at all. And so when you have a non-investment credit rating after having one, and you combine that with Williams Partners, who has this massive backlog of projects that they want to build out. We're talking $30 billion worth of projects.
That they need to finance.
And they need to find some money for it. And you combine that with the fact that Williams Companies is trying to merge with Energy Transfer. There's a lot of questions as to, could Williams Companies' kind of shakier debt situation roll into Energy Transfer equity and compromise its debt ratings?
Do you remember any breakup fees or anything?
I do not remember if there's any breakup fees related to this one.
I wonder if everybody's gonna be like, okay, maybe we need to wait a little bit or something.
Whatever happens here, because if you look at how much the market is just abusing this, I mean, you've got both Williams are down more than 40%. Energy Transfer equities down 39%. Energy Transfer Partners is down 23%. Sunoco Logistics Partners down 26%. I mean, this is just in 2016 alone. I mean, these are big moves.
It's 2 weeks into the year,
and
this is
they're really the market seems to be pricing in management is going to do something here. Either they're going to, most likely, somewhere along the way, Williams is going to have a dividend cut or something along those lines.
What's their yield right now? You were saying earlier
I don't have it.
They're asking for the cut.
Sorry,
It's
I don't have it
yielding
in front of me now, but
didn't you say
it's in the
20?
high double digits.
Yeah, okay. I thought you said
mid to high teens for Williams right now. And basically that shuts off the equity market. They can't raise capital to build there. And with a junk rating, it's going to be more expensive to build. It's just, it's begging for management to make a move and say something that they're going to do something to shore up the balance sheet and or cut its growth rate, something. But just kind of sitting here and not doing anything.
There's plenty of precedent to cut that dividend. I mean, stop me.
Kinder Morgan just did it a month ago.
It was,
plenty
of precedent.
TK Tankers did it a little while ago. Master Limited Partnerships that have, for years, I would say irresponsibly paid out too much money to shareholders in relation to what they've been bringing in. We talked about it with Kinder Morgan. As investors, we pushed for them to give us more cash, and they, kind of put themselves to the brink with paying out all that they could.
I try to get out, and they keep pulling me back in.
And now we're in this situation.
There. Yeah.
So, I'm not surprised.
Taylor, are you interested in any of these names right now? Doing a little nibbling at all?
No.
Cool.
Maybe
conservatism wins the day.
Maybe add to a couple in the next few months, but right now, my only thought was just to buy an oil-linked ETF and just let it
call
ride.
it a day.
Yeah, not a producer ETF, just a commodity ETF.
Right.
And just wait till $60 to $80 in oil comes back in 3 to 5 years.
Okay. All right. So segment 3 is our mailbag. Leland Payne of Fairview, Texas writes, I'm really interested in what you, Taylor, and Tyler think about PXD. In the past, Motley Fool has high regard for the company, and last week they sold 12 million shares priced at $117. They announced the offering late Tuesday, January 5th, after closing at $125, and the stock opened up the next morning at $115. The funds are being used to fund production increases. Does this make sense for this company with WTI trading at $31 trending downward? What do you guys think? Taylor?
Well, that's Pioneer Natural Resources. Is the ticker we're talking about. No big deal. And
I just assumed everybody knew.
Now they do.
It's the energy show after all.
Yeah,
That's right. Yeah, we got some.
This stock hasn't fallen much in the last year and a half
compared to its peers.
Hold on. Let me pull it up for you guys while you keep going.
Compared to the peers, no. Especially lately, and you look at its multiples. It is trading more highly than its peers. So relative to its peers, maybe stock issuance wasn't a terrible idea.
Right. Get the money while the getting's good.
Yeah, maybe they want to go buy a cheaper, smaller peer or just some assets from one of them. But you look at a 7.6 times EV to EBITDA multiple versus a peer group of about 12 people that I looked at, average 4.6. So it is trading higher, much better debt profile. And it was, I guess, Wall Street looked at it as kind of an encouraging fact that this deal was fully subscribed. So,
well, and it wasn't surprising that it opened up a
assets-
little down because it was priced, a little bit
Right.
below the market.
Yeah.
So that's fair. I mean,
But still, 117 that it was offered at is still valuing shares much higher than its large cap E&P peers.
Right.
And I think rightfully so. It's growing production thanks to some efficiencies that it's still getting from optimization, reduced cycle time from well to well, and longer frac lines. So it's doing things that are going to keep it competitive in this low price market. And it's got tremendous assets in the mid-con.
Cool.
Yeah, and one of the things that they do have slightly going for them is if you look at sort of the way that cash lays out, a lot of it seems to be they're getting to the point where all of these efficiencies and price gains, and now with, I guess you could say, the services companies giving them such a larger discount than what they were used to getting, they're starting to see a point where, for a while there, I think it was even David Einhorn was looking at them as kind of the, one of the staple examples of what's wrong in the shale patch. But they're starting to get to the point where there's capital discipline there, and those efficiencies are finally starting to catch up. Just actually pulling it up here, in the past 18 months, right about July of 2014 is when we started to see kind of the shakiness in the market. Pioneer's down 47% from there compared to then. Just to put that in a little bit of perspective, Continental Resources is down 75% over that time. And Chesapeake Energy, everybody's favorite's down 87%.
Speaking of Continental, they have zero hedges this year because Harold Hamm stripped all those away, whereas Pioneer Natural Resources has 80 or 85% of its 2016 production hedged.
Wow.
Yeah,
So,
they made some decent moves. I mean, it's hedged at $60, which doesn't sound
good right
fantastic,
now.
but when you're
double the
comparing it
price
to
of-
$29,
Sounds good right now.
$30, it sounds amazing.
Looking like freaking
amazing.
geniuses over here.
And that's what Harold Hamm just declared he thinks the price is going to end at in 2016 is $60 a barrel. So even if his prediction comes true, Pioneer isn't losing money on those hedges.
Yeah.
Yeah. Another little added bonus that they have is last year is they sold assets to enterprise products partners for they netted about $1 billion, but only got half of it. So this half of the year they're getting an extra $500 million, which will help to kind of pay for that capital spending. They kept their capital spending for 2016 just about level what they did last year, while still predicting 10 to 15% production growth. So if you can get that kind of efficiency, you can't really fault them too much for being a little bit more aggressive while everybody else is reeling.
I mean, it's being a little greedy when everybody else is being fearful. I don't know.
It's not the worst thing in the world.
No. Okay, cool. Well, that is it for us, folks. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. And as always, people on this program may have interests in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks. So don't buy or sell anything based solely on what you hear on this program. For Tyler Crowe and Taylor Muckerman, I am Sean O'Reilly. Thanks for listening, and Fool on.